The top 5 real estate mistakes investors make and how to avoid them. Real estate investing can build wealth faster than most other vehicles can. But you're just starting out, it's easy to make the wrong moves and lose time and momentum. In this video, I'm going to show you the top 5 mistakes that investors make and how to avoid them. Trust me, I've seen it firsthand in Dubai, UK and Sri Lanka as well. So let's get to it. The number 1 mistake people mostly make is actually chasing cheap, not value. Now what do I mean by cheap and not value? It's a rookie mistake because everybody thinks, as humans do normally in everyday life, if I buy something cheap, it must be worth it because I'm buying it cheap and it's got value because of the fact that it's cheap. But it doesn't necessarily mean it's value if it's cheap. So don't go buying cheap thinking it's value, because that is a big mistake to have. For example, if you buy a cheap studio and in an area where there's no rental demand and it sits there empty for months, then you're not really getting any value from it and you're actually losing out on your return on investment. Meanwhile, if you buy an expensive studio in an area where there's high demand and also 95% occupancy, you're going to make great rental income and yield, plus also you're going to make capital growth because that property is going to be in more demand because of the fact that it returns a better yield. So ask yourself, what's the yield of the property? What's the resale potential? And in the area under development, or is it declining? Don't ask, is it just cheap? Ask, is it a smart investment? Number 2, your exit strategy. Now, as in a stock and a share, people don't know, but when you buy a stock, you should always decide where you want to exit. So therefore, you never get greedy. So am I buying for a 20% return? Am I buying for 5 years? Am I buying for 3 years? Or am I buying just to make 2%? It's the same in property. Ask yourself, how am I going to get out of this? What is my exit strategy? Am I going to flip it and sell it in 12 to 8 months? Am I going to rent it long term? Am I going to Airbnb it? Am I going to refinance and pull the equity out and buy something else? The mistake most investors make is that they buy emotionally without asking the question, who will I buy this for? Who will buy this off me in 5 years' time? Is the market appreciated? Can I exit without losing money? So you don't make money when you buy the property, you make money when you exit the property. So hence why you need to ask the question, when am I going to exit and how am I going to exit in order to make money? Because that will determine what you buy, how you buy and when you buy it. Now, one of the big mistakes a lot of people make, especially when the interest rates were lower, was over-leveraging. That's very dangerous. Why? Because if you get a mortgage and you leverage, yes, your cash is working smarter for you, but if you stretch yourself to buying 3 properties instead of 1, then you're putting yourself in the firing line. Why is that? Because by over-leveraging, what could happen is your cash flow could go negative after expenses, you're relying on market rises in order to survive, and also if one of the properties actually goes vacant or interest rates go high as they did from 0 to about 4.5 literally in months, then you will lose out on cash flow and not be able to pay the bills and ultimately get repossessed or have to sell the property at a value which you didn't want to. So the rule of thumb normally is never borrow more than you can sustain with a 3-month vacancy period. Keep cash reserves and buy based on today's numbers and not on future numbers. Mistake number 4, understanding real costs. So what do I mean by real costs? Real costs are basically what people sort of may not understand or see straight away, but as they buy the property and they get to manage it and start in the process, they realize, oh, I didn't really think about this because it wasn't on the paperwork, it wasn't something that you see every day. And also at the same time, when you're running your home, you may not think about it because of the fact that you're running your home and you pay for these things automatically. Hidden costs are service charge is a really big thing. Now, if you buy a flat with a service charge which is really high because it has a swimming pool, it has lifts, it has a gym, and it has all the fancy amenities. Yes, you may get a little bit extra rent from it due to the fact that it's more desirable, but the service charge you pay for it is much higher, and also during the vacant periods and stuff, the service charge needs to be paid, so it's a drain on your cash flow. Property maintenance. Are you aware of how much, even if you have a property which is new, eventually you will still need to refurbish the property, paint the property, things can break even if they're under warranty, and so a budget needs to be set aside for this. Vacancy periods. Ultimately, for example, in Dubai at the moment, with the Iran and crisis going on, people may not come here and visit here as much during the summertime, especially because it's hot. So it's already a period of low vacancy, but with regards to the actual situation in neighbouring countries, it may be even lower than normal. So therefore that has to be accounted for and taken into consideration. Seasonality, for example. Mortgage insurance, tenant turnover costs, i.e. check-in and check-out costs, agency fees, DLD fees and admin fees. So if you buy a unit, for example, with a 7% gross yield, after all the above, you may only net 4.2. So that's still fine, but you need to know about it up front. So if you think you're getting a 7% yield, but you're really getting a 4% yield, that's fine. But if you then get a 2 or 3% yield because you've missed out one of the things above, then you're going to be in trouble because it's going to affect your cash flow. So always overestimate your costs rather than underestimating it, and that way you'll be prepared and profitable. Number 5, this is one of the most important. Don't do it alone. This is one that stops people from scaling. Now, you think you're saving money by not hiring good bankers, lawyers, consultants, agents. You're actually costing yourself more money. The best investors in anything, regardless of whether it be property or setting up a business, they hire a good team. A trusted real estate agents who they know the local market, good lawyers who can check contracts and make sure that you're legally covered, a reputable mortgage provider to save you costs and make sure that they know the future of where mortgages are going so that they can guide you in a way to be more profitable in the future and take advantage of rates now or fix them for the future, a good property manager, especially if you're abroad, because ultimately you're not going to be there and you're going to have to rely on them to tell you exactly what's happening and why it's happening. And an accountant who understands an investment as a structure and for tax purposes wherever you live. So you don't need to know everything yourself, but you need to make sure that you hire people that you trust and are knowledgeable. And this is something that's really important if you're looking to scale your business for the future. Now, a bonus mistake, emotional buying, is something that you must avoid at all costs. You can't go in there expecting it to buy something just because you love it, or just because your wife loves it, or just because you think it's going to be a great home for you one day, or something that you love. Because ultimately, it's a business decision. You're either making an investment or you're buying a home. So even if you are buying an investment, don't treat it like as if it's your home and you're going to live there. Ask yourself, who is your target audience? What do they require? What do they want? And therefore then you base your decisions according to that. Don't get caught up in the views, the fancy finishing, the hype around the developer. Don't get caught up by the fact that there were 10 units and there's now only one left, or that there were 10 units and it was fully sold out and there's only one left, one available again, because these are all tricks of the trade that people can do in order to influence you in order to purchase a property. I think they call it FOMO. So let's quickly recap over the top 5 mistakes that real estate investors should not make. Chasing cheap deals and not value. Not having an exit strategy. Being over-leveraged. Understanding real costs and then not doing it alone. And the bonus one is not getting emotionally attached and thinking like a pro. Now, if you can avoid these, I know they sound simple in reality, but like life, if it was simple, then everybody would be making. You're already 90% of the way there and far ahead of a normal investor. Don't hopefully learn the hard way, as I have done in the past, by making the mistakes and then not making money and not making capital growth and then having to sell that property. But luckily I was able to buy multiple properties and learn from my mistakes, which outweighed the other one. But if you're going to buy a property, one property, and it's your starting one, then get in contact with us so that we can help you navigate everything, help you to achieve your goal of whatever it may be, and help you to actually purchase the right property in the right area with the right budget. So DM us, call us, message us, and we hope to catch you soon, Rainmakers.